Hey everyone, I'm Tim Perotti. I'm the Chief Investment Strategist at WealthVest's, and if you've seen or read any of our work, you know that we have a view that not nearly enough attention is being paid to the massive reversal of long-term drivers that delivered really 40 years of wage disinflation. Their demographics, the retirement of the baby boomers, globalization rapidly turning into deglobalization being accelerated by geopolitical tensions, falling labor productivity, and finally falling legal immigration. But away from wage inflation, we're concerned that not enough attention is being paid to what we see as a secular energy inflation issue. Secular energy inflation in oil and oil products like gasoline and diesel, which is being driven by long-term underinvestment, both upstream in developing new resources, as well as downstream where there is a really acute underinvestment in refining capacity. In addition to that factor, and that really is the key one, we view climate change as truly existential, and it's a problem that really was borne out this summer, and it is proven that we have no choice but to confront in earnest. And lastly, geopolitical disintegration. Well, let's start with underinvestment, because that really, as I said, the key point that we want to make. And to me, this makes a lot of intuitive sense, right? Energy investors do not want to see company managements spending any money on growth CapEx. They want the money back. While the energy transition is going to play out over decades, the oil and gas industry is still a melting ice cube. It may be an incredibly slowly melting ice cube, but there is enormous pressure on management teams to run their businesses for cash. So by way of illustrating, CapEx among the 5 super majors has fallen 50%. So in a world where you've got oil prices going up, kind of recently coming down, this is 2022, we're going to start this chart at 2012. You've had a little bit of demand destruction. Obviously, you've had the massive release of the SPR. But overall, you've had oil prices going up. And yet, in the last 10 years, you got oil CapEx down 50%. So as a matter of fact, oil prices, with oil prices at 90 in the 90s, you've seen the Permian Basin actually cut the rig count over the most recent period. In refining, the situation is even more severe. So start at 2019, 50% decline. 50% decline in CapEx. So the result is we have less refining capacity now than we did pre-pandemic. And if you ask any energy analyst, if they think that capacity will go up or go down from here, you'll get a unanimous response that refining capacity is only going one way, and that is lower. If you ask refining managements, they'll tell you the same thing. So I know gasoline prices have come down recently, but there should be little doubt that whenever we see demand increase again, we're going to see gas prices making their way towards the $5 level again and $6 distillate. So that really is simply the bottom line with oil. One of the painful unintended consequences of addressing climate change and embracing a green agenda is that we are going to be dealing with very sticky and very high oil prices and oil product prices for the foreseeable future. So let's talk about the inflationary pressures from making this energy transition. To me, the most tangible and inescapable inflationary pressure will be to the cost of a transitioning power grid. We already know that we have an energy grid in the United States that has suffered from underinvestment. And to make the transition to localizing production, think home solar, that will necessitate massive long-term investment in modernizing power distribution. Roughly half of your electricity bill, depending on where you live, is driven by transmission and distribution. And those costs are only going higher and in an accelerating manner. Lastly, I just want to touch on geopolitical disintegration. As we speak, countries where you have huge growth in the global middle class, as defined as transitioning from more of a sustenance existence to consuming far more petroleum products, countries like India, the most populous nation on the planet, and Indonesia, are looking at the Russia-Ukraine situation and saying, we aren't interested in picking sides. And basically, if we can get cheap Russian oil, we're really not interested in picking sides. So all of a sudden, in a world where we're already consuming 100 million barrels a day of oil, supply becomes less fungible. And we'll begin to move towards geopolitical alliances. And that is not good for Europe, especially. And frankly, it further empowers OPEC, who have now made it clear they really don't want to see oil much below $100. So to sum up, in addition to the really stunning reversal that we've talked a lot about in worker availability that has brought us this secular wage inflation, we are also confronted with a new world where oil and energy prices broadly are going to be higher, and they're going to be higher for longer. Thank you for watching.